Good morning, everyone, and welcome to a fresh new session on credit risk modeling. And in the last session, we were talking about Basel. Before I start off my discussions today, I would just like to understand whether I am audible to everyone or not, and whether is my screen visible or not. It would be great if you could give me a written confirmation. Just give me, if you could just type in your chat box, that would be great. Wonderful. So, uh, just to start off the discussions today, we do a quick recap of the stuff that we had done in the last class, and from there we'll take it up in today's discussion, right? So, in the last class, we had started talking about we discussed the loss distribution of the bank, right? So, from there, what we did was we moved into the concept of Basel, the Basel Accords, the Basel Committee of Banking Supervision Accords, right? And we saw that there are these three versions of Basel which have been published till date. And from there onwards, we started exploring the different nuances of Basel. And one of the things that we looked into was the three pillars that Basel has. One is the minimum capital requirement, second is the supervisory reporting, and third is the market discipline, right? So, in the first pillar, when we talk about the minimum capital requirement, Basel lays the guidelines for the banks so that they could keep aside money, they could keep aside capital, which would actually absorb the credit risk, market risk, and the operational risk, the risks arising from credit risk, market risk, and operational risk, right? And within this, we are focusing mostly on the borrower risk over here. So that's the first pillar. So whatever credit risk models we are developing over here, the Basel PD LGD and EAD model, the and all these kind of models, these are all pillar one models. And one thing that we saw in the last discussion was the role where PD, LGD, and EAD actually fits in while we are developing Basel, right? So we saw that most of the case over here, in most of the cases, while we are talking about credit risk, we are looking at behavior the last one. We are looking into the probability of default. We are looking into the loss given default. We are looking into the exposure at default. So over here, when we are talking about behavior risk, right? So mostly in this, while we will be talking about Basel models, we will be focusing mostly on behavior risk as far as our discussions are concerned, right? So over here, we'll be talking about the deterioration in the willingness to repay, and to assess the probability that the borrower's willingness to repay would deteriorate in the next 12 months. That is the probability of default model, right? So when we are talking about Basel models, right, Basel models or the AIRB suite of models will have the two different sets of models that we will develop. One, which talks about the deterioration in the willingness to pay. That's the borrower, the obligor side, and the other two set of model talks about the losses that might result if the willingness to pay of the borrower had deteriorated, right? So this is what the overall idea was. Now coming to the next one. Now we saw that the Basel as an accord is a capital, it's a guideline which talks about capital adequacy. And when I talk about capital adequacy, the first question that comes out to us is what exactly is the capital of a bank? So we saw that the banking capital has three tiers, right? Tier 1, Tier 2, and Tier 3, out of which we are mostly concerned with Tier 1 and Tier 2. So Tier 1 capital is the purest form of capital, and that is the equity capital that goes in over here. So tier one capital is comprised of, or it comprises the equity capital, right? And the tier two capital comprises of all kind of predicted capital, which includes say undisclosed reserves, revaluation reserves, allowances for provisions, and allowance for loans and lease losses, and so on. So mostly when we are talking about developing PD LGD in models, we are trying to frame an understanding of the expected loss. So this is a kind of a projected or a predicted kind of a capital. Therefore, this has to go into, or this part, or this all these modeling that we do used to frame an idea of the provisions. These provisions, they form a part of the tier two capital. Therefore, over here, whatever we are talking about, most of the models that we'll develop, we would be developing it for the tier 2 model, because all the expected losses are absorbed by the tier 2 capital, right? And our focus over here at this point of time was to explore these three component models for tier 1 and tier 2, right? So we will explore these three basic component models. And what we did in the last class was we looked into what is the EAD model, what is the PD model, what is the LGD model, right? And what are the different ways, or what could be possibly the different ways of modeling each of these models. Now, from there, we moved into talk about the different kind of products that are there, right? Now, Basel divides the banking books into two parts. One is the retail part, the other is the commercial part. So one is the retail portfolio, the other that I have over here is the commercial portfolio, right? And we talked about the difference in the definitions of the two portfolios. And we saw that the commercial portfolios talk about us. So how is it that a banking book would identify a retail portfolio, and how is it that the uh, you know how is it that the accords would identify the commercial portfolio? So this is what we had discussed in the last class. The retail portfolio would be comprised of, or it's a portfolio which is comprised of large number of accounts, small exposures, and these exposures are collectively managed. On the other hand, there is a commercial exposures, a commercial portfolio which you have relatively lower number of obligors, but the average exposure per obligor is very large, right? So the commercial portfolio is divided into two parts basis the sales turnover, right? So in a commercial portfolio, an obligor would be categorized as SME if the total sales, the total revenue, total revenue is less than equal to euro 50 million. So if it is less than equal, if the total sales of the firm is less than equal to the 50, euro 50 million, then it's clubbed as an SME. Else, if it is greater than 50 million euro, then it is identified as a corporate, right? So in the last class, we focused more on the retail side of things. So we started talking about what exactly is a retail obligor. So an obligor is a retail obligor if it is, if the exposures are less than equal to 1 million euro, right? So even if you have lent out to a small business, right, and the amount of exposure is less than 1 million euros, then that is classified as a retail fund. So that's classified as retail, right? On the other hand, when we start talking about this, start talking about the QRRE. So basically, the retail portfolio is subdivided into three parts. One is called the QRRE. So the QRRE is qualifying revolving retail exposure. So this comprises of products like credit card, overdrafts, and so on. Right? So any kind of retail products which are revolving in nature, that is called qualifying revolving retail exposures. Right? Now, now over here, there are two other subparts, right? So we'll explore each of these sub portfolios. Now, the first question that comes out is that why is it that we are exploring these sub portfolios? So we are exploring the sub portfolios because we need to define the products and we need to identify the key characteristics of each of the products, right? And that is where this part comes up. That is the reason why we are exploring each and every products one by one. Now, if you look over here, that so basically what we have started off talking about over here is about the QRI. Now, when we are developing models, right? So when we are developing business models like this, regulatory models or models of scorecards and so on, then it is not only about the statistical methodologies. It is not only about the statistical models. It also involves, it also involves a synchrony that needs to be built along with the business, right? So the business also needs to be synchronous. It also needs to be with sync with the statistical model that we are developing. So therefore, understanding each of the products which are there is first important before we develop the statistical models. Before we go to develop, a PD model, LGD model, or EAD model. So even more than SAS or more than the statistical methods, it also involves bringing in the products because from each of the sources of the product, there would be some important business variables which we need to identify as modelers, right? So before we enter into the model development domain, right? Before we enter into developing a PD model, LGD model, or a EAD model, what we need to do is we need to frame an understanding. We need to frame an understanding of this particular fact that the key variables like so what are the key variables associated with a product, right? What are the key analysis, what are the key type of accounts that we need to take up and so on, right? So this is the part from where we had started off talking about. This is the part we had started discussing in the last class, right? So we had stopped at that part. So we took up talking about the credit cards, right? And from there, so that's the part that we had talked about. So in today's discussion, we will carry forward we'll carry forward this, and we will cover different parts of model development. So we'll cover up different portions of you know we cover up different portions of model development, model validations and all. But before that, we create a framework of the different business products, what are its different business characteristics, and how is it that it is like how is it that a variable is important to us, which are the key variables, which are the variables which must be in place for a behavioral model for a particular product. Because whether you develop a PD model, you develop an LGD model, or whether you develop a EAD model, you need to know which are the core variables which would fall in place, which would be the variables, which would be your, which would be the most critical variables to look out for, from where we'll derive further set of variables. So that's the part that we would be exploring today. Now, Now, if we have a look into this balance, say, let's start with credit cards. So, credit cards, as we know, is a revolving product. So, what is a revolving product? A revolving product is a product which does not have any fixed maturity. So, in a revolver product, the so the most important characteristic of a revolver product is that it is an open-ended product. It's an open-ended. So basically, the question that comes out over here is that why is it an open-ended product? It is an open-ended product because of the fact that you have a given limit, right? So you use the card up to the limit, then you cannot use the card any further. But once you know remove the once you clear up the payments, then again the product becomes usable. So it does not have any fixed maturity. So the product which fall under this segment, the QRRE segment, so these products do not have any fixed maturity. They do not have any fixed maturity. They do not have any fixed maturity. So this is precisely what the overview is. Now, for these revolver products, we have seen that there are different characteristics. Right? So there are different key variables. So what are the key variables? The key variables include variables like balance, limits, payments, delinquency, and the month on month. Now these are balance, limit, payments. These are very basic variables. Right? They are the primary variables. Now, if I need to capture the behavior risk for credit cards, right, then there is no point. So there is no point in kind of just using the primary variables. So we need to use variables from the primary variables. We need to derive the variables from primary variables, which will be used for model development, which will help us capture very important idea about the riskiness of the borrower. So if there are two borrowers, I should be able to identify, okay, this is a good borrower, this is a relatively less risky borrower, and this is a relatively more risky borrower. So this is what we could actually do over here. Now, over here, say for example, the example that we started off with. So there is a guy who has a limit of 50,000, right? A credit card with a limit of 50,000. So limit is the maximum amount that you can use on your card, right? And the balance is 20,000. So this guy has actually used 20,000 out of that entire 50,000. So therefore, what I want to know is that like how is this guy? Like this guy has used. So what I do is using limit and balance, right? I design a new measure called utilization. Now this utilization gives me an idea about how more risky or less risky this particular borrower is, which is like 40%. Now, say say there is a guy who uses so there is another guy who has a card of limit 1 lakh but uses 35,000. So if we compare the balances of the two borrowers, one uses 20,000, the other uses 35,000. So by looking into the utilization, I cannot make any absolute decisions. So therefore, what I need to do is I need to create out a balance. I need to create out a new variable like utilization over here, right? So the utilization over here is 20 by 50 is equal to 100 is equal to like 40%. Now over here, if you have a look into this particular behavior, then we can say that utilization helps us capture the usage of the borrower that the borrower has on the card. Now, just assessing the riskiness of the borrower basis is utilization is not enough, right? So I may be a person who utilizes 80% on my card, but every month before the cycle ends, I give back the entire money. Right? I pay back the entire money. Therefore, if I am paying back the entire money, in that case, you know, uh, I pay back whatever I have used. So I am not going delinquent or I'm not a risky borrower. That means I'm a high utilization borrower who always pays back his money on time. That is the reason why That is the reason why this utilization is of 40%. So basically just looking into the utilization would not actually help us in assessing the relative riskiness of the borrower. So what we also need to do is we need to assess the payment patterns that the borrower has. So therefore, we have another measure called the payment balance ratio, right? So in the last session, we had this particular discussion that if there is this kind of a pattern. So where this is the blue line shows my utilization, the red line shows my payment to balance ratio. So I can see that this guy uses a huge volume of the card but does not pay back sufficiently. Right. So that is basically what the idea is, that the guy does not sufficiently pay back the money. And if the guy is not sufficiently paying back the money, so then again it basically implies that that this guy has a low willingness to pay, and if this guy has a low willingness to pay, then this guy might go ahead and he might default in the future. So therefore, to assess the behavior, so basically when I'm developing be it a PD model or an LGD model or an EAD model, I'm trying to assess the behavior risk associated with the borrower, right? So another important variable that we saw was the delinquency variable. So what is delinquency? Delinquency is nothing but the ability of the borrower, the fact that the borrower actually misses out on the payment of an installment. Right? So if the borrower misses out on a misses out on the payment of the EMIs, then the person is said to be a delinquent borrower. Here, so is this was the idea of delinquency clear in the last class? Great. Now, when I'm talking about a behavior risk, I'm trying to model the behavioral risk. In that case, so when I'm trying to assess the behavior risk of the borrower, in that case, delinquency plays a very important role. Because, say, suppose standing today, right, I give you two borrowers to assess that who is a more risky and who is a less risky borrower. So the first thing that you do is you see whether this guy has missed out any payment or not. So you see that as on that date, the guys that are standing in front of you have been delinquent. So one is a delinquent guy, the other is a non-delinquent guy. Now, obviously, apart from without looking to anything, your most instinctive judgment will be that if this guy can be delinquent once, there is a relatively high chance that this guy might go in the next 12 months and default. So the delinquent guy, very intuitively, we can say that the delinquent guy will always have a higher chance of defaulting than the non-delinquent, right? Okay. So before I move on, there is a question from Anirudh that what is the payment balance ratio? The payment balance ratio is, say, suppose, so this is your balance or the amount that you've used on your credit card, right? Now, what happens is out of this 20,000, you pay back, pay off, say, rupees 12,000 a month. So, how much of the outstanding balance have you paid back in that month? So that is what the payment balance ratio checks. So your payment for that month on your card was 12,000, and the outstanding balance that you had over there was 20,000. So therefore, this is nothing but zero point 0.6, or you have 60%. So your payment balance ratio for that month was 60%, right? Anirudh, are you clear on this idea? No, not necessarily. So Anirudh, there's a question over here that so for good borrowers, it is the payment balance ratio is 100%. Not always. So what we can say is for the good borrowers, the payment balance ratio is relatively higher than the payment balance ratio for the bad borrowers. So you need not always be paying back 100% on your card. So say a guy who is actually paying back the minimum amount on the credit card. So every credit card bill comes the minimum amount. That is the minimum amount that you need to pay within that day to avoid the delinquency, right? So one thing is that you may pay back that card, right? So one thing is you may pay back that amount every month. So then you are a non-delinquent borrower. So you are a good borrower. Now, within the good borrowers, there are different classes. So there are borrowers who pay back 100%. There are borrowers who pay back some amounts of it. Say there are borrowers who pay back uh, like only the minimum balance, slightly more than the minimum balance, and so on. So that is the way it goes about. Okay. Now, every credit card. Now, for modeling credit cards, one very important thing that we generally have over here is the month on books, right? So, what is the month on books? The month on books is the vintage of the borrower, the vintage for which the borrower has been on the books of the bank. So, it shows for how long has the particular borrower been on the books of the bank. Right? So borrowers who have been on the books of the bank for substantially long periods of time, those borrowers are considered to be the seasoned borrowers, which is identified through the seasoning analysis. Right? Now, the next question that comes out to us over here is that for credit cards or for revolving products, how do we distinguish between the relative riskiness of the borrowers? So, how do I identify that borrower A is more risky and borrower B is less risky and so on? So, how do we identify between the relative riskiness of the borrowers in the credit card problem? Right? So for for a credit card. So this is what we will be actually exploring today. That how can we use the why are these called the key variables? How is it that these key variables help us distinguish between the relative riskiness of the borrowers? Right? So this is what. So this is the next thing that we do. Just give me a minute, guys. I'll just be back and we'll get started. Okay. So as we were saying that. So as we were saying that so as we're talking about the different variables, so if I have a credit card, right, and I have all the different variables over here, the balance, limit, payments, the delinquency, the month on book. So first of all, if we are saying that all these six variables, four five variables are very important variables for risk model for developing a Basel model for a credit card, then the question that we need to address over here is that why is it so important? Why is it that balance, limits, payments, delinquency, and month on books are so important? As we are saying, so that means these variables must have the capacity to distinguish between, or they must have the ability to distinguish the relative riskiness of the borrowers. Distinguish between the relative riskiness of the borrowers. So it must have the capacity to distinguish between the relative riskiness of the borrowers. Right? So if there is a ability to distinguish between the relative riskiness of the borrowers, then what do we need to do over here? Uh, so let's see from this part. Now, one case we have already seen is where we had used, we had used utilization and the payment balance ratio to assess the riskiness of the borrower. So I had used utilization, which had two important variables. One is the limit, and the other is the balance. Right? So that is one part. And the second that I had over here was the payment balance ratio. So in the payment balance ratio, I had used two variables, the payment and the balance. So now, if I look into this part, right, you can see that these three variables, payment limits and balance limit and payment, has become very important, or they together, or when I combine them in different ways, or when I create different derived variables out of them, what I can see is that I can actually identify whether the borrower is a good borrower. So out of two borrowers, I can rank them according to their relative riskiness, right? So this is how, this is the reason why we say that these variables are independent variables. Now coming to the next part. Now coming to delinquency. So what does delinquency do? Delinquency says that, so delinquency shows me whether a borrower as on a given month has missed a payment or hasn't missed a payment, right? So basically, out of delinquency over the last 12 months, I can actually create out a variable of from that, which is say the percentage of delinquency over the last 12 months. So what I can see over here is that the percentage of delinquency over the last 12 months. So greater the number of times the borrower has been delinquent over the last 12 months, the more the chances has he to default in the next 12 months. Right? So if I am a borrower who has been becoming very delinquent very frequently and have been missing out payments, then there is a high chance that I am unable to create the model. So basically, it is very kind of thing, like so it's the idea that happens over here is that we are, so basically what we get to see is that the higher the percentage of delinquency over the month, over the last 12 months have been, so it means that the more probable it is for the borrower to default in the next 12 months. Correct? So different variations of the delinquency variable can be created to frame an understanding of the fact that whether a borrower is a good borrower or a bad borrower, or to relatively rank the borrowers according to their riskiness, right? On the other hand, similarly, what we have also seen is that the month on books is a variable which can help us distinguish between the relative riskiness of the borrowers again. So every time So every time this particular thing happens, so every time we use these variables, these basic variables, we can always create the idea about the relative riskiness of the borrowers, and hence these, what I can say is that these variables will help us distinguish between the uh, riskiness of two or more borrowers. Now, not only it's not only these variables, but I can create other basic variations of these variables as well. Say, for example, uh, I have utilization, right? So I can create a variable like this. Say the first variable that I create from here is the max utilization. The max utilization in the last 6 months. In last 3 months. Then the next is max utilization in the last 6 months. 6 months. In the last 6 months. Max utilization in the last 6 months. Then another thing that I do is the max utilization last 12 months. So now what you can see is that I have computed the maximum, a trend of the maximum utilization, right? So basically what one thing that I can also do is I can do it on a month basis. But over here what we are doing is we are using the we are looking into the max utilization in the last 3 months, we're doing the max utilization last 6 months, and max utilization last 12 months. Now what I can do is if I get to see that there has been a sudden jump in the utilization, or there has been a sudden jump in the maximum utilization, then I can, you know, try to find out that what has happened. So if it is that, say, in the last 3 months, in the most recent months, the utilization has suddenly spiked, right? In the last 3 months, the utilization has suddenly spiked, then this variable can be what. So if it has spiked, say 12 months ago, and then it has not been that higher, then that's a different story. So if the max utilization spiked in the most recent 3 months, then that's a different kind of a story. So what we can do is we can look into the maximum utilization in the last 3 months, 6 months, 12 months, like this, right? So over here what we can also do is we can also find out the percentage changes in this maximum utilization. So percentage change in the max utilization. Max utilization last 6 months minus the max utilization last 3 months. So similarly, instead of looking into the max utilization, also what you can do is you can also look into the max utilization. Similarly, another way you can actually tap this part is you can look into the average utilizations. So you can actually check why has the average how has the average utilization behaved over the month. So has the average utilization in the last 3 months, average utilization in the last 6 months, average utilization in the last 12 months. So like this. So how does the average utilization this thing I mean, how does this actually happen? So, be it max utilization or average utilization, you can actually use them and try to understand, try to capture the relative riskiness of the borrower. So, if you suddenly see that your average utilization has spiked up at a certain point of time, and then it has gone down, then you know that there is some changes in the behavior occurring, right? So, an increase in the average utilization in the month, followed by a decline in the average payment balance ratio, shows a reduction in the willingness to pay back, and hence it implies that there would be an increase in the overall chances of the probability of default of the obligor. Right? So if you see that the average utilization is going up or has gone up last period, and in this period the average payments have gone down, then you know that the willingness of the borrower to pay back is actually going down and his chances of default is actually increasing, right? So average utilization compared with the average willingness to pay or the average payment balance ratio, right? So with the average payment balance ratio will give us an idea about the average willingness to pay of the borrower. If the average willingness to pay falls down, the probability of the borrower to default on the credit card will increase. So this gives us an idea about the average willingness to pay. This gives us an idea about the average willingness. Right. So if the average willingness to pay of the borrower goes down, the probability to default increases. right? So if the average willingness to pay goes down, the probability to default increases, right? So up to this part, is it clear? Great. Now comes the next question, that how will the PD, LGD and the EAD models be developed for this particular product? So how will the PD, or what will the problem be looking like? What should be the important type of PD model variables? What should be the important LGD model variables? And what should be the EAD model variables? How should the data for, or what type of accounts would be computed or be used for developing the PD model? What type of data should be used for developing the LGD model? And what type of data should be used to develop the EAD model? So over here what I have is the PD, LGD and the EAD. So these are the three, you know, broad kind of models that we will be doing. So over here we'll explain the following. First is the data requirements. What type of data is required? What are the type of accounts that is required for developing this PD model? So one important part over here is the data requirement. So what type of accounts, what type of data should be used to develop the PD model, what type of account should be used to develop the LGD model, and what type of account should be used to develop the EAD model. So these are the three broad kind of stuffs that we would be looking right. So over here, so after data requirement, we'll also look into the important type of the core covariates that are required, the most important covariates that are required for building the model, or that finally turn out to be very significant in this model. Covariates. Now the next part is, so the next part talks about the different type of segments that are there in this set of models. So segments, right? So data requirement, covariates, and segments. So the first thing that we need to understand is that what are the dependent variables? What are these important dependent variables, and how is the data built around them? So these are the first two important things that we generally try to answer over here, right? So let us start off by talking about the PD models. So what is the dependent variable in the PD? So if I talk about the PD model, So Akash has a question over here. PD model is used for application scoring, behavior scoring, and collection scoring. Do we cover all three in this course? Collections is outside the scope of this module, right? Because collection is not this. Collections is a totally separate part. So I covered up to the part where the entire credit life cycle, so the point from where the account originates to the point where it is written off. Collections is outside the scope of my module. Now, first of all, PD model is not used for application scoring and behavior scoring. PD model is used for estimating the tier 2 capital, right? Now, scorecards are used for generating application scores, and the business problem is very similar to what the PD model has, right? But the type of the nature of the variables and the type of the type of the data is very different for application scoring. Even though, so at an application stage, what we try to estimate is that the probability that y equals to 1 if the borrower is a good borrower. So out of that, the 1 minus the probability of y equals to 1, that becomes the application PD, right? The probability of default that you calculate at application, or that is also known as the acquisition PD at times. But ideally, that is not the PD model. PD model per se, or the probability of default model, the term probability of default model is a regulatory term which is used to denote a PD model which satisfies all the requirements of the Basel model, right? So this term PD is generally used in a very regulatory sense. Now, for application scoring or for behavior scoring, the business problem for a behavior scorecard is exactly the same as that of a PD model. But that's a behavior scorecard and this is a PD model. Now, at a very high level, right, the steps of model development are very similar for the application scoring, behavior scoring, and developing a PD model, right? But the PD model, the role for PD model is that PD model develop for the Basel side, or for when I talk about a PD model, I talk about a set of a model which satisfies a set of criteria, right? Which satisfies a set of criteria, and in this set of criteria, there are set of Basel conditions which needs to be fed into it. So the PD estimates that we generally get from the models are much more conservative than that we get from the behavior scores, right? So we'll not be using that. It's not appropriate to use the term PD model for application scoring or behavior scoring. So those are behavior scores or behavior PD, and or we can say it's an acquisition PD or things like that. But the PD model per se is a regulatory term, right? So I generally do not use the term PD model. So what I generally talk about is an acquisition scorecard and or a origination scorecard and origination and a behavior scorecard, right? So I generally look into it from that perspective, right? So it's not appropriate to use the term PD model, but I do get to understand what you are saying. So yes, we'll be developing the framework. We'll be developing both application scorecards. We'll be developing behavior scorecards, as well as we'll be developing the regulatory PD model or the Basel PD. Now, what is so important about the Basel PD is that the Basel PD is a through the cycle estimate, whereas the behavior scorecard PD or the probability of default estimate that is generally obtained from a behavior scorecard, that is a so that is essentially that's essentially a point in time kind of a probability of default model. So when we talk about this, we'll come to what are through the cycle PD is, what a point in time PD is. We'll come to all those, right? So but first let's understand the modeling framework associated with it. Then we'll talk about it, right? So there are wide variety of models which are used to develop Basel PD models, right? Now there again a set of separate models which can be used to develop behavior scorecard models, but they may not always be applicable for developing Basel PD models. So there is a difference, distinction in the term, right? So that's it. So having said that, let's just proceed towards understanding this business problem and checking all these criteria that we have actually laid out. So talking about PD. So the dependent variable over here is defined as follows. That is y equals to 1 if if the borrower defaults in the next 12 months. If the borrower defaults in next 12. So this next 12 month is something which makes the model predictive or forward looking. Equal to 0, right? So y equals to 1, the borrower defaults in the next 12 months, equal to 0. Now when I talk about this probability of default model, now the most important part to see is this one in the next 12 months. So this next 12 months is typically known as the performance. So basically there is a trick that needs to be involved into the analysis when I am talking about this. So there needs to be a forward looking performance period. A period over which the performance of the borrowers need to be assessed. So that is where the performance period, the story of performance period comes in, and it is this performance period which is a very important concept in this modeling exercise, right? So how to derive the performance period? We will be coming to that. Now, deriving an optimal value for the performance period is a general practice for developing business scorecards, right? But for regulatory models, the performance period is always fixed at 12 months. So, for a detailed portfolio, if you are trying to develop a probability of default model, then it is fixed at 12 months, right? So this is where the performance period is. For the story for the performance period comes in. Now, when the story for the performance period is coming, so before that, what we will talk about is the data. Data in terms of two things. One is the variables, and the next is prediction. So the first and the most important thing that we have over here is to understand, is to identify that what is that optimal data set which we can use for model development. For developing the PD model, I need to first of all create the appropriate data, right? So I must have that appropriate data. I need to create that appropriate data set. Now, once that appropriate data set is created, Then I can go ahead and develop the model or look into other factors. But first, the question is, what is the type of data? So what are the type of variables that must go into that data? What are the type of the observations, or what are the type of the accounts that needs to go into the data? Right. So this is the most important part. Right. So first we'll talk about the PD model data considerations. Yes. So Akash is a question over here. So Akash, so Anirudh had a question on how to derive the performance period. So Akash says that it is vintage analysis used to derive the performance window. Yes, absolutely, Akash. It is used to derive the vintage analysis used to derive the performance window, but that is for business forecasts. So when you are developing Basel models, as these retail models, the PD is or the performance is fixed at 12 months. So for Basel model, for developing Basel PD models, you don't need you don't need to do a vintage analysis, right? So vintage analysis is used to done. I mean, the vintage analysis is used to create a choice of the performance period while developing behavior scorecards. So where my performance period is very portfolio specific, because over there I'm using a most recent portfolio loss behavior in developing the models. Whereas for developing a Basel model, I'm using a historical loss behavior. That is the reason why Basel has fixed it on the fact that you need to predict the next 12 months of performance for the data. Right? Great. So let's start by talking about the data. The first and the most basic data requirement is that if you are to develop a Basel model, the first thing that we need to do is that the data must be of 5 years. 5 years at least. So I need to have at least 5 years of data. Now, when I say that 5 years of data, right, I do not essentially mean that it has strictly to be 5 years. It can be more than 5 years, right? So, what Basel says is that if you have more historical data, the bank has access to more historical data, which can, you know, represent the loss behavior, or which is representative of the loss behavior of the firm, which does not explain very high or abnormally high losses or very high or low losses. So if it is of a representative loss behavior of the firm, then you can even use for the historical data, right? So if there has been certain structural change in the portfolios, then the structural change periods cannot be included. So you have to take the data after those structural breaks have occurred, right? So it's like 5 years of data with one downline. So with one downline. So what I'm trying to do over here is, so what we see.
that there is, so if I'm trying to develop a probability of default model, I'm using at least 5 years of data with preferably one downturn period, right? So it is always suggested that within the data span that you are using, your data span must be such that it must include one downturn period so that it covers out one whole business cycle. Right. Now, when I talk about downturn, I mean downturn. I do not really literally mean a recessionary period or thing like that. But if you have access to such a period, then that's all the more better. So basically, when I talk about one downturn period, so not necessarily recessionary, but one downturn period, so that you can actually create a robust capital requirement that if your business goes through a downturn, if your economy goes through a downturn, then your model should be able to predict those as well. So given a downturn, my model should be able to predict the PDs and the LGD and the EAD figures, right? So this downturn period to be included for more robust behavior. So this is what the data requirement is. So for example, if I am to use a data which covers, so for us, the maximum or the best possible downturn period that we can capture. Okay. So Anirudh, there's a question over if there's any structural change, as you said, in that case we need to take data after the change. Yes, Anirudh, if there is a if there's a structural change, say change in the way data has been maintained, the change in important, say change in the values of the variables, or change in any major management decision which has impacted the behavior of the portfolio, so there has been a merger or acquisition, stuff like that, then you need to take data after that event. Okay. So that is the next question that I'm coming to, Akash. That is it okay to take data of 2008 to 2013 global crisis if I want to create model now? Yes, I am actually coming to that question next. So now for us, the best downturn period or the best example of downturn period that we have with us is that of the 2008 financial crisis, or as we call it, the global financial crisis. Is the global financial crisis. Now, see if I want to include the global financial crisis in my data. Now, when I say include, I just do not mean just take the data point within the time frame over which I am doing. Now, over which I am developing the model. So now, if I am developing the model so I want to develop my Basel model for the year 2017, right? So now let me first consider the assumption that Anirudh has, that Akash has made. That will take data from 2008 to 2013 to develop the model now. Right. Now the question that comes out over here is that yes, I can take this because it's at least a 5 years of data, right? So it's a 5 years of data and it includes the downtime period, right? So that is how I can justify that I should take it. But there are challenges to this snapshot and to this time interval. What is that? The challenge over here is that it starts from a downtime period. So it starts from a downtime period, and then the remaining period is a recovery period. So basically, the trends of most of the business variables would be something like this. Say at least for delinquency, it will be something like this. So I'm plotting delinquency because delinquency is the most important variable when we are developing a behavior scorecard. So I'm just plotting out the delinquency. Delinquency. Sorry. This is the time, and this is the delinquency. So now what you see over here is something like this. Initially your delinquency rates will be very high and then you will. So what you get to see is if you use this and if you develop your models on the basis of this period, right? Your models will be actually fitted to a portfolio which shows declining trend, but that is not the case. So what you get to see over here is a declining delinquency trend. What I get to see over here is a declining delinquency trend. A declining delinquency trend, right? So your model would be fitted to this, but this is not your, or this may not be your actual delinquency trend. This may not be the actual trend. This may not be the actual trend. So therefore, this is not the representative delinquency trend which is there. Now, this would be the actual trend if the following criteria holds. So you have started on from 2008, right? Your data starts from 2008 right up to this is 2030. This will be your actual trend if the following was observed. So your data say it starts from 2006 and then it goes on to 2030. Now if and 2008 falls in over here. Right. So if I saw that this had happened, then I can say that my portfolio has a declining trend. And then this would be correct. But this may not be correct because this is an abnormal period, right? But before the abnormal period, it might have been that the flow rates have been like this. So they spiked out in 2008 and then again went down. So if I start off with an abnormal period in my data, then I might get a biased image of the loss behavior. So this might result in a biased behavior, in a biased loss behavior. Biased loss or biased delinquency distribution, because I have started off from an abnormal period and then it went on to recovery. So obviously the bad rate fell down. So in order to know whether whether there was a downturn or not, whether a downturn was included or not, right? So whether the bias, so whether the delinquency distribution, so basically, if I start off with an abnormal period, then I might end up with a bias part. Therefore, this has to be included, not just considered. It has to be included in the data period. Now, when I talk about include, it means there is some point before that point, some points after that point, and in between it is included. So that is the reason why it is. That is the reason why we say that it is included. Right. So this is the way this time period should actually appear. So you have 2006 to 2008, then from 2008 to 2013. So this is where 2008 is meeting. Now if I see that my loss behavior was like this, so this is what I expect generally to happen, because in 2008 the default rates spike up and the delinquency rates spike up and then they again go down as the time period goes on. So this is how I capture the loss rates. Now, coming to the next question of 2030. Now the time period over ends here with 2030. The problem with this specification is that even though it completes the 5 years stuff, but this does not reflect the most recent loss behavior. Does not reflect most recent loss behavior. This reflects the most. This does not reflect the most recent loss behavior. Therefore, if your model is being validated by independent validator and you develop a model on this, what he'll come back telling you is that, man, you have used data 5 like after 2013, but just to include the downturn period. So therefore, the data sample that you have observed or you have used is a biased sample. So therefore, you actually cannot use this for your model development. You have to include the most recent snapshots as well. So Anirudh, that was a very good observation that you had made, that we need to include the most recent snapshots into data snapshots in order to develop the model. Right? Clear up to this point? So basically, if I am trying to develop this model, right, the data point that I would have chosen is something like this. Say I would have chosen a data point from here, like, so my choice would have been 2006-01 to 2017. This would have been my choice of the data, right? So over here I would have 2008. So mostly the most difficult period of the downtown would have gone through 2008-01, or say 806, say 2010-05. This would mostly be my downtown. If I am to develop a model for 2018-2019, this would be my choice of the data. And the data has to be chosen on a monthly basis. So 5 years of monthly data. So this part talks about 5 years of right. So at least, rather let me say at least 5 years of monthly data, including a downtime. So this is how I would choose my modeling data. This is what the time frame of the data is, right? So this is what time frame of my. So this is how I would choose the time frame of mine. Clear on this part? Preeti, Akash, Anirudh. Now, however, so what does Basel say for clients or for people or banks who do not have 5 years of data? So for them, what the banks need to do is the banks need to say, suppose I have 3 years of data, right? So what I'll do is I'll use the 3 years of data and I'll develop the model, but I'll keep on refreshing the model with the most updated data sets, right? And the data sets should be, the time frame should be so chosen that it represents the historical loss rate behavior. Or the historical loss rates must be represented in the data. So the data that you choose, that must identify the historical loss rates. Okay. So the next question that I have over here is from Akash. So what will happen in case of China? Their economy is booming over the last 25 years with no counter. Now I am not very sure, Akash, whether Basel as an accord applies to the Chinese market or not. I'm not very sure of that because Chinese market is different from other time periods, right? So and like from other economies because it's a regulated economy and all. So I'm not very sure whether it applies to the banks in the Chinese market or not. Right. So mostly the applications I have seen happening is for open market economies, the banks who operate in the open market economies. So for China, we just need to clarify that. However, if an economy has been booming over the last 25 years, then you may not have a downturn period. So to face a downturn, you just need to keep aside a buffer, right? Because since the Chinese government, since the Chinese economy is centrally monitored and controlled by the government, therefore I am not very sure whether Basel as an accord would apply. So they might have their own accords, but others I'm not very sure. Great. So having said this, having identified the data requirement, the next thing that we need to talk about over here is the variables and the observations. Now you have chosen the data set, right? But you cannot use all the observations and all the variables in a given data, right? So this is where we need to have an understanding. So the next part that we go into is the variable observation, the variable and the observation exclusions. So for developing a probability of default model, the variable and the observation exclusions are very important. Now the observation exclusion generally happens of observations and the variable and observation exclusions generally differ again from product to product. So all observations exclusions may not hold for all the products, right? So similarly, all the so every depending on the different products, there would be okay. So the variable and the observation exclusions. Right? So the variable and the observation exclusions differ from product to products. So all it is not necessary that all the products would have the same kind of exclusions, right? At the same time, it is also not necessary that everything will be having a observation exclusions. But yes, generally there are certain observation exclusions. And so what we'll do is, right? So what we'll do is we try to understand that for credit cards, what are the different kinds of products that we generally have? Like what are the different kind of observation exclusions that we generally have? So we're talking about the variable exclusion. The variable exclusion is more or less similar for all the products because all these are credit risk products, right? So variables which do not reflect borrower risk or transaction risks are supposed to be removed from the data. So variables will only include borrower risk and transaction risk. we have the borrower's risk and transaction risk. So variables which reflect the borrower risk or transaction risk are actually kept back in the data, whereas variables which do not reflect these risks are actually excluded. So apart from this, right, all other variables have been excluded from the. So talking about transaction risk, so transaction risk is, say for example, uh, you make to fail, I mean you fail to make a payment, right? So that's a transaction risk. So that transaction risk can happen because you are not paying back the credit, or because there may be other factors which is deterring you for making that payment. That's the factors which adversely affect the transaction, or which shows the, which captures the risk of making transaction. That's a transaction risk. And borrower's risk is risk which arises from the behavior of the borrower. Now, however, these are very closely related to each other, borrower risk and transaction risk, right? So these are the variables which capture these things. So if there is a borrower's risk, if the borrower loses a job, that increases the risk of the transaction, of the EMI transaction to happen in the next month. So that is the way the, you know, the borrower risk and the transaction risks are associated with each other. So what we have over here is that variables which reflect as the transaction risk or borrower risk are included, right? Now, apart from this, if you have any other variables, right? So any other variables apart from this, so variables which capture operational risk or operational variables. Checkbook ID, bank status, checking, say, branch where the account was opened, and so on. So these are called operation variables, are excluded. Variables which reflect market risk, say any kind of bond purchased by the borrowers or any information on the market factors, so any kind of market risk variables are removed from the data. So all these variables are actually removed, right? So what we have over here is broadly the operational variables and all the market variables, and all these variables are removed from the data. So the data will contain only those variables which reflect transaction risk or borrower risk. So these variables are removed, right? So now, once we have developed this borrower's risk transaction, so once we have identified those variables which are to be kept in the data, right? The next set of variables that we talk about over here is the observations. So what exactly is the observations? So observations are nothing but the rows of the data. They are the data rows. Now, what we try to understand over here is that what are the observations that should not be included in the data. So the next question that we try to assess is what are the observations that should be included, and those which are not included are the ones which will be. So what do you think are the observations which should be included in the model data? So observations, so accounts which are open and active as on date, as at the date from when you are trying to make the prediction, the accounts which are open and active and on the books of the bank, active and on the books of the bank, on book. So active and on the book of the bank is to be included in the model. So all kind of accounts which are closed, which are written off, which are deceased, which are charged off, all these accounts will be removed for the model development. So PD data for developing the probability of default model, we are only to use the accounts which are on the books of the bank and active, because these are the accounts which have not met with the fate or with the fate. So I need to assess what are the chances that they would default. So if an account is already closed the account, or if an account has already defaulted, then there is no point in retaining the account back for PD model or calculating the PD, because I know the account is already closed on the books of the bank. I do not get to see how it's performing. Accounts which have defaulted have already defaulted. Accounts which have deceased are deceased. You do not get to see any other performance on them. So lost cards, fraud cards, etc. So these are accounts which are to be removed, and only the accounts which are active and on the books of the bank need to be kept back for developing the PD model, right? So what you can see is that as we are moving across, right, we are removing observations, we are removing variables, and we are actually extracting out a relevant sample for the model development, right? Now, so basically, and that is the reason you remember, guys, we said that when we start off with the model development, right, we can never use the entire population. The entire population is not always available to us, right? So what we generally do is we have to always work with sample, and this is one major reason as to why we are working with sample, because all the observations and all the variables in the data is not really related to us. We don't need these variables. So what we'll do is we will start working with a subset, a more relevant subset. So after all the observations, ideal observations and variables are removed, what we end up with is the base data. Now it is on this base data that we develop our model development data. That's a training data. We'll talk about the model validation data. Within validation, we'll have out of sample validation and out of time validation. So this is the base model data. Okay. So I'll take up a question that Anirudh has over here. So this is for testing, but for development, don't we need to consider closed account? No, Anirudh. For development, for developing the models, when I am developing the model, if an account is closed, it's closed, right? So its performance does not occur in the next 12 months. So the account has been closed. So as long as the account was not closed, I can consider the account. But in the snapshot where the account gets closed, after that onwards, I cannot use that account. Now, coming to Akash's question, what about inactive and dormant accounts? Inactive or dormant accounts are also a part of the exclusion, right? So they also need to be excluded if the account was inactive in performance, right? Now, coming to next question, because closed write-off account can also give insights. Now, closed accounts do not give me any insight. I want to understand that there is an account on the book of the bank. Is the account defaulting in the next 12 months? So if the account has been closed, the account is already met with a fate, right? I don't need to calculate its probability of default. So therefore, calculating probability of default is only applicable to open accounts. And yes, closed and write-off accounts do give us insights, right? Right, especially write-off accounts. So write-off accounts would be considered while developing the LGD models, because they will not be considered while developing the PD models. Yes, model will be built on the history, right? But the flag that you will create, the dependent variable flag that you will be creating, that will be a forward-looking flag built on the historical data. So say standing on 2016-01, you want to know whether a borrower is going to be a defaulter or not. So you have the next 12 months of behavior for that data, for that account, right? Now, if that account has been written off as on 2016-01, do you need to create a PD flag for that, because it has already defaulted? That's why it has been removed, right? So this is the part that we'll discuss in tomorrow's session. So tomorrow we'll talk about snapshot periods, we'll talk about performance period, and we'll justify each of these exclusions in terms of the snapshot month and in terms of the performance month. So whatever model building is going on in the history period, but from the point of time where an account has been closed, the account is closed and will not be considering that account for developing the model further. Because once an account has been closed or the account has been written off, the account has already met with a fate, with a conclusion. And I do not require to use this for further calculation of probability of default. So we define the concept of a snapshot month. We will define the concept of a performance month, and based on that, we will take up the next level of discussions. Right? So we'll discuss these concepts tomorrow. Thank you guys. Thank you and have a great weekend ahead. Bye bye.